required to give you what's called a risk warning. So let me get that out of the way. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds you cannot afford to lose, and seek advice if you do not understand the risks. All information that's provided in this webinar is for educational purposes only. ETX Capital and the presenter are not financial or investment advisors, and we do not recommend any securities or instruments of any kind. Any securities or instruments that are mentioned tonight are for educational purposes only. Now remember, when you're trading on the ETX platform, depending on which item you're trading, if you're using leverage products are very heavy in risk. Please understand those risks. If you don't, please ask somebody to explain them to you, or contact a financial advisor, and make sure that you do understand what you're doing when you use leverage so that you don't lose all of your money by a simple mistake. Now, for those of you that are joining us through the web tonight, ETX is a fast-growing financial services company, and we are based in the City of London, and you can come by our offices. We're open to the public. You can come by and see us anytime. We're authorized and regulated by the FCA, the Financial Conduct Authority, and we're a member firm of the London Stock Exchange. Now, on our platform, we offer, or on our site, we offer four different types of trading platforms. We have our ETX Trader Pro, which is our web-based feature, which allows you to trade right on the web, no downloads, and it's very simple, and we have everything in one concise screen for you. You can use it all around the globe, anywhere that you have an internet connection. Or if you prefer, or you're more advanced, and you want to master the MT4 platform, you can trade with the ETX MT4 platform, which will give you all the advanced charts and let you apply all kinds of expert advisors. You know, all of those automated advisors, whether it's auto chartists you want to use, you want to get some through the internet, and you can add them right into your trading system or into your charting system. And you can also set up automated or set up parts of your trading to be fully automated. MT4 is a platform that you control. You decide what you want to use and what features you want. And then lastly, we have our ETX binary platform, which you can use and trade on as also. So remember, you have lots of choices when you're trading at ETX. You can trade stocks, commodities, indices, and currencies. And you just decide what method is best for you. Or if you have a good portfolio and you have it well balanced, you could have several different types of investments going on, or you can use one to hedge against another. So make sure you master your money management skills and your risk management skills. So once again, tonight's class is on the basic charts. We're going to try to give you a foundation to start building your market understanding and your technical analysis abilities. Now, charting sometimes seems very complicated. It is a little bit on a science. Okay? Don't misunderstand. It's not something you can pick up instantaneously, but it's not all that difficult. Once you've practiced these, once you've got familiar with the different kinds of charts and you've learned to use them, they'll become secondhand in no time flat. It's not something you need to go to school for. It's not something you need to study hours on end. You'll be surprised if you just start looking at charts on a daily basis. Like when I get up in the morning, I do two things. I look at the price of the assets, and then I quickly look at all the charts on all the assets I follow. Not my own charts. I just look at charts on some site because I can see what happened overnight. I can tell a whole story of what happened overnight by price and movement in charts, because charts tell you a lot once you know how to read them. Now, my charts are completely different because my charts have all the built-in technical analysis tools. And I've already set up all of the assets I trade. My support and resistance are there. My trend lines are there. If I'm using Fibonacci, because you're applying different strategies for different markets for different assets. So once you have your own personal chart set up, you can lay your strategies and write on your charts and decide what you're going to do right on your charts. But first you have to understand just being able to look at a bare chart and price on a chart and be able to tell a story. Now, Forex charts can look drastically different depending on what options you want to use. You could select them. You know, when you look at somebody else's chart, sometimes they're very confusing. Why? Because They use reds and blues in their lines, and they know in their head what they're using the reds and blues for. They know their purples indicate this, and they know their oranges, because it's their own little system in their head. You might like grays and yellows. And once they're your own lines on a chart, you understand them much easier. But eventually you can look at other people's charts and figure them out. Now, charts usually have settings for display style and price, time frames that you want to view, and time frames can be anywhere from 1 second to 10 years, depending on the charting system that you choose. Now, price can usually be displayed as a candlestick, a line, or a bar. Now, these are the three classic different types of charts, and all the other, and there's lots of charts, because there's lots of gimmicks and lots of systems, and now that we have HTML and all these computerized charts, people are constantly coming up with new kinds of charts because a computer can do them. Back in the old days when I started trading, we almost all used bar charts because we were doing everything by hand, and you needed to have a very good visual image of price, but we didn't want to use candlesticks with all the little bodies because it was time consuming. Okay. Today you can flip from one to the next to the next. But if you think of your chart as your roadmap to success or your blueprint to a building, if you start out with the proper foundation or the proper basics and build an understanding, you'll be able to get where you're going more successfully. Now, charts typically have several different display modes for displaying price. One method that price can be displayed is called Japanese candlesticks. And I know every trader out there wants to trade with Japanese candlesticks. Why? I couldn't tell you. Because, like I said, when I started trading, we all trade with bar charts. Most hardcore traders trade with bar charts. Japanese candlesticks have become the buzzword of retail online investing. There's nothing wrong with Japanese candlesticks. Don't misunderstand me. But there are all kinds of theories for using candlestick patterns to predict price. And most people, unfortunately, get stuck in the reds and the greens and think these reds and greens are telling them something. But it virtually has nothing. Japanese candlesticks have nothing to do with that. Okay, so unless you're going to actually learn and put the time into learning all the candlestick patterns and what the candlesticks tell you and what the differences are in the wicks and the bodies, then you're getting yourself involved in a complicated system you don't understand. But if you do understand it, there are some very critical and very valuable things that candlesticks can help you with. But price can also be displayed as a line. A line chart is the bare basics of a chart. Line charts are a good way to simplify the display of a price. The line chart will show you the closing for each period, but it shows you virtually nothing. It just gives you a general idea of how the markets are moving. And the last of the three is the bar chart. The bar chart is extremely similar to the candlestick chart. A bar chart will show you where the price opened, what the high was, what the low was, and where it closed. So basically, there are three areas of charts, the three types of charts: line chart, bar chart, and candlestick. Now, once you've determined what type of chart you're using, and today, again, because of all the computerized charts, you don't have to stick with one. Like I said, I do like candlesticks, but I want to draw all my lines on a bar chart. Then I can flip on the button and flip it over to candlesticks, because when I'm drawing all my lines on, I don't want all those colors and those candles to make things more conflicting. So once I've got things in the right place, now I might use candlesticks to give me an open or a close or a signal to buy or sell or the signal to enter the market. Okay? It depends on your strategy. But the thing about charts is the more details you add, the more likely you're not going to get lost. The example I keep using is a roadmap. Okay. Now, 1 billion years ago, I used to have an office in London, and I had a business partner. And we would travel to meetings. And this was pre-GPS, pre-computers. And in the old days, you'd get on the telephone and you'd call somebody and ask them where their office is, and they give you directions. And they give you general directions, and you'd get there. Now, I was kind of the lazy guy. I didn't read maps. I wasn't very good with maps. My business partner was great with not just maps. He had this huge road atlas in the glove box, and he could read everything on there. Now, if I got really lost, I could pull this atlas out and kind of figure out where I want to go. Where my partner, Peter, could tell me, well, you know what, get in the right-hand lane and take the second turn on the roundabout, and then get in your left lane, and we're going to go over and use the exit going up. Okay, we'll pass the third stoplight, and when we pass the school, you'll want to hang a right. Okay, I couldn't read this on charts. Peter was great at reading this on charts. And the more time and effort you had, guess what? When Peter was in the car navigating and I was driving, we never got lost. Okay, we got where we were going quickly and on time. Where I spent most of my life pulling into filling stations, asking directions, and leaving an extra half hour early to get to a meeting so I didn't get lost and get there late. Well, this is the same thing with charts. Now, what you're looking at is a line chart on the screen. This is a line chart for the Euro-US dollar. Okay. And this is a 30-minute chart. That means at the close of every 30 minutes, we would put a dot on the chart for the price at that moment. Then we connect the dots together to form the line. Okay, very simple. I'm using a 30-minute chart at the moment only because this is what I use for most of my trading. Not for a rule of thumb for you guys or anything else. Charts you can use from 1 minute to a 1 minute chart, a 5 minute chart, a 10 minute, all depending on what you're comfortable with and what trading style you have. And you can use multiple time frames also. Now, there are some line chart or some charting services that will let you use the open every 30 minutes or the close every 30 minutes. Some will give you the medium price. But the abundance of charts out there, and most of the charts you look like when they're a line chart, is the close of every 30 minutes in a 30-minute chart. If you're looking at a 15-minute chart, it's the close of every 15 minutes. Using a one-day chart, it's the end of each day. But it's just one dot. So what happens is you don't get to see the actual peaks and valleys. You don't get to see the movement. All you see is the price at the end of that period. So a line chart is the most simplistic, but it gives you a pretty good idea of how price is moving when you look at it. But it gives you no information and no detail. From here, we go to my favorite and most of the world's favorite. And this is called a bar chart. Now, again, this is a bar chart for the same asset, the Euro-US dollar, at the same time in a 30-minute chart. But what you see is more information. You get a lot of information in a quick, easy visual format because each one of these lines denotes that same 30-minute time segment that you put the close down on the line chart. So in other words, this close right here is the same dot that was on that line chart. But what we have here is the open, the high, the low, and the close all in one line. So we can see how volatile the market was. We can see who dominated the market, not just where price closed, but did the bulls take control for a little while, push the price way up, and then lose control so it closed lower? Okay. Did the bears push it way down but ended up easing out before the time segment was over? You see all of this in this one line. Also, this one line, this one bar with the highs, the lows, and the opens, close, also let your eye see some price that's in common. You can see if there's a significant area where there's lots of lows, highs, and closes at a specific price. Or you get to see a trend line much easier because you can see lots of tops in common. You can almost visualize a trend line on a specific, at a specific movement. So a bar chart gives you all of this in a very easy visual format. And charting is all about visual, seeing patterns, repeated patterns, seeing price movement on a chart. Now on a bar chart, what we see is the open, the high, the low, and the close. So sometimes you'll see a bar chart referred to as an OHLC, open, high, low, and close. So now what we do is pretty simple. we put a doohickey to the left at the open. We put a doohickey to the right at the close. Doohickey, dash, a line, whatever you want to call it. It just doesn't go across. It's just a step outward. You put a dot at the high and a dot at the low, and you draw a line connecting these all together. And this gives you the bar on your chart. Now, if you stepped up from the open to the close, in other words, you climbed up the ladder or the step, it's a bullish signal. Whereas if you step from the open, which is the left-hand line, down to the close, that is a bearish signal. Very simple, not complicated, but lots of information in this very easy to see visual format. Now from here, we go to candlesticks. Now candlesticks have the same characteristics of a bar chart, as they provide the open, the high, the low, and the close within one bar, or in this case, one candlestick. But the main difference is the ease of interpretation purposes. We can easily interpret bullish and bearish patterns from the colors of the body of the candles. Candlesticks have been used since the 17th century in Japan and have been improved in the 18th century by a Japanese rice trader named whatever his name is, and are now widely used in Forex trading due to the ability to display multiple data points instead of one. Today, it is one of the most commonly used charting display methods with online retail traders. Now, again, what we have here is the same chart you saw for the bar and the line chart, same time, same asset, same time period. And what you see are all of these green and red candles. Now, green and red has become the most used color system for candlestick charts, and green denoting bullish and red denoting bearish. Back in the old days, before we had computerized charts and we were doing charting by hand, we used black and white candles, hollow candles, and filled-in candles. Now, you can choose your own color system. You can use oranges and purples. Okay, you can use golds and silvers. You decide. All you have to do is denote which one denotes bearish and which one denotes bullish. Okay. The thing that is most complicated about candlestick charts is traders start to think that, see all this red? They think this red is all telling you something, but it isn't. Okay, candlesticks are all about the body and the shape of the candle. So like here we have what's known, I'm sorry, my brain just slipped. Here we have a very precise candlestick with virtually no body and a long upper and lower wick. This is called a koji. A koji tells you that there is huge amounts of market indecisiveness because the small body means that the open and the close were relatively the same. But you have to know that. You have to know what that candlestick means. You have to know what that interpretation is. Now, when this appears in an uptrend or after a big green body, and then you have a red candle with a very big body, it actually has a name to it. And it actually, together, this pattern or this formation of these three candles is telling you something about the market. And each one of these, you have to understand. See, like this candle here, just trying to get my marker back on for you. This candle here has no upper wick. Okay, long lower wick and a long red body. So what does this tell you? Okay, it tells you the story of the bulls and the bears. What it tells you is, from the time this session opened, the bears controlled the markets. But they pushed the asset way down, but they ran out of steam before the end of the session, and it closed a little bit higher than where it had gone down with the shadow. But all of this is telling you something, and it's the formation and the candles together. So in other words, these three green candles here don't tell you that the market is going to turn and go upward. Doesn't work that way. Okay. Like I said, you happen to see a lot of red candles, but look at this, you see green candles in the middle of red candles. Okay. It doesn't tell you the market's going down. There's other things that tell you this. So the thing about candlesticks is it does work wonderfully well. If you want to learn the 32 different patterns, what they mean, how to interpret them, and how to properly use them. But you can determine, charting is a very personal thing. You decide what you want to do. But as you notice, what we do to draw the candlestick is we put a line across at the open. We put a line across at the close. We put a dot at the high and a dot at the low, and then we connect the high and the low to the body of the candle. Doesn't it sound just like a bar chart? OHLC, open, high, low, and close. Now, in this case, if the close was higher than the open, again, it's a bullish signal. So we would either leave it white or we would color it in with our bullish. In other words, we would color it in with the green. And it's a bullish signal. Well, it's a little bit more complicated. It's the same data set, and it's exactly the same as you would have drawn it for an OHLC or a bar chart. Okay. Now, the thing is, these wicks tell you a story, and the size of the body of the candle tells you a story. But unless you know what that story is, you're just kind of wasting your time. Okay. Now, once we've decided what type of chart we're using, and again, because of today's new charts, we can jump from one to the next to the next. The same thing is with time frames. Each different time frame can give you clues to the personality of a trading pair. Whether you're looking at a 15-minute time period, a 1-hour time period, a 30-minute time period, each one of these will tell you something different. Now, I use, like I said, my personal trading, because of the type of trading I do, I use a 30-minute chart, but then I use a 15-minute and a 1-hour to verify my determinations. Do these prices, does this trend line hold up when I switch it to a 1-hour chart? When I switch it down to a 15-minute chart, do my decisions still hold up? Okay. You can find out whether the pair tends to move steady during its trends, or if it tends to stall often. You can find out if it's volatile during daily sessions, but steady over weekly sessions, because you can still look at that chart and look and see how that asset's moved in a day, because the prices don't change. But if you're looking at small segments, an asset can be very volatile in a 15 or a 30-minute segment, but when you look at it on a daily chart, you can see that line is pretty steady. Okay. Viewing a currency pair in multiple time frames can help you find good entry and exit points, depending on the strategy that you want to use. Day trading a currency can make a lot of sense to traders to look to take maximum advantage of daily volatility, but keeping the daily trend in mind can help day traders focus on the bigger picture. But a day trader, okay, would want to be looking at very short time periods, because he would want to see exactly, because he's only planning on being in that market for one day. So he would look at a daily chart, but then he'd look at a 15-minute time frame, because he wants to see, if he's trading an asset to go up, he wants to know where the bottom is. If you're putting your stop losses, you need to know how volatile the market is, because you don't want to get stopped out only because the market, you haven't predicted the market volatility correctly. Now, Forex trading attracts many different types of traders with many different types of systems. If you want to trade a currency pair or any asset, it's best to become familiar with it as possible. Viewing a currency pair in multiple time frames is part of the process of learning its personality. Understanding the currency pair's personality can help you in your success with trading. So let's pop over real quick. I have a live chart set up here. Let's pop over to a live chart, and let's just see how you would do this on charts. So what we're looking at, as soon as it pops up on your screen, is the euro US dollar in a 30-minute time frame. Okay. And we can see where it's trading, and we're using a line chart. So this looks just like the line chart you saw in my screenshots. Okay? But this is just the current market value. The current today's chart. This is a live chart you're looking at. If we want to switch this over to a bar chart, we simply click on bars, and lo and behold, we have bars. So you can move from one to the next. But you can see how this bar chart is a lot more informative than that line chart. And then once again today, because of the easiness with these candles, is we can click on candlesticks, and we've got the same thing in candlesticks. So because for me, candlesticks make the charts too colorful when I'm working, I'll do my work on a bar chart. I'll draw my trend lines. I'll do everything here because personally, I just like the nice clean look. Then I can switch it over to the candlestick chart. So it's easier for me if I'm going to put a trend line on my chart, okay, to draw the trend line without the colors and all the wishy-washy stuff on there, and get my nice clean trend line on there. And hold on, I just want to get this marker off. So let's put a trend line on here. Let's see if we can get a nice trend line. Okay, so now we have a nice clean trend line. I'm going to draw on here some support and resistance lines I'm just kind of making up. And remember, if you come to our class 2 weeks from now on support and resistance, I'm going to teach you something called eyeballing. And the best way to get support and resistance is by eyeballing the prices. There's many ways, and you should use multiple determinations to get support and resistance. But to me, eyeballing is one of the best ways to do it. And it's easier for me to eyeball common prices in a bar chart than it is in a candlestick chart, because there's too much going on again with the candlestick chart. Okay. So here we have a trend line. Now, if we were to look at this in multiple time periods, so we're looking at it right now in a 30-minute time frame. Okay. If we were to go back and look at it in a 15-minute time frame, okay, we can see that maybe that trend line isn't so valuable, because we can see that it doesn't have that much in common with these prices, but we can see that we can see the difference. We can see more information. Okay. But if we were to click it back to 1 hour, now we again see that trend line is really a very good trend line. That is supporting the price line pretty well. So we're happy with that trend line. And this is one way I validate my trend line, is with multiple time frames. But by looking at this asset in 3 different time frames, we're also getting to know a little bit more about it and how it's trading now. And it tells a story. And the story is more important than the 15-minute, 1 hour, and 30-minute chart. Now, I'm going to back up here because a lot of people don't understand when we talk about time frame. When we say time frame, and we're looking at a 15-minute chart. Now, the chart on your screen is only so big. It fills in your screen, and it only goes back so far. So in our visible field of view, we can only get so many lines on that chart. Now, of course, you can pull a chart back as far as you want and see all that. But in a 15-minute chart, now remember, a chart doesn't do any analysis. It's only giving you data. It's being fed right in through data feeds. So there's no interpretation to the price on a chart. It is written in stone. But when you look at price in a 15-minute time frame, you're still looking at the exact same price movement. But remember, you're looking at the high, the low, the open and the close for that 15 minutes. If you were looking at that in a 30-minute chart, what happened was that 15-minute price movement is included in that 30-minute chart, but that 30-minute price frame could have had a much higher open and a much lower close, so you don't see the detail. If you're looking in a 1 hour chart, okay, it actually would consist of 4 15-minute lines, but you don't see those. You see the 1 hour chart. See how it opened at the high of that 1 hour, got the low of the 1 hour, where it opened at that 1 hour, and where it closed at that 1 hour. So you can start missing small pieces of information. But if you're trading an asset, if you're a day trader or you're a short-term trader or you're looking to get in and out to make a couple pips, you're more concerned with the smaller time movement. If you're a swing trader, you would be more concerned with a 5 or 6 hour chart or a daily chart, because you're looking to buy an asset now. Like, you'd like to buy it at the lowest point you can buy it, but you're looking to sell it, 30 or 60 days from now. But you also have to measure market volatility. If you're only looking to stay in the market a short time, you're more concerned with what is happening right now. If you're looking to stay in an asset for the next month, you need to see how volatile that market, or where the low should be, or where you should put your stop loss, because to cover not where it's trading today, but where it's going to be trading over the month's period. So using these different time frames, okay, are very important in understanding difference. So if I click on a 1-day time frame, it also tells me a great deal about the asset you're looking at. Because what we're looking at on the screen right now is the euro-US dollar in a 1-day time frame. So this is taking us all the way back to September of last year. So even though the euro, when we were looking at in a 15-minute time frame or the 30-minute time frame, we're looking at a downtrend, correct? And we're looking at the price moving down. But as soon as we shifted over to a 1-day time frame, look at that. We're not really looking at a downtrend. We're looking at a very short downtrend, but we're looking at the price actually moving steadily in an uptrend. So this helps you understand how the asset is moving now, how it's moving in a bigger picture. If you put your kid and you marked you took his height and you said, oh, look at that, you grew a ½ an inch over the last 2 months. Well, that's really nice. But if he was undersized for all of his classes, as all of his friends, and you were expecting him to grow 3 inches this year, well, that's kind of deceptive, because a ½ inch over the last couple months was really good, but it's very disappointing in the longer term of where things are. So by determining this, you could start making more use of your knowledge and a better understanding of a currency. By using charts on multiple time frames, you can also see specifics. Like, you might notice that gold always falls at the end of the Asian session, climbs in when the Asian session is closing up to the European session, and then settles out. But you might see that every day at this 2-hour time frame that you have gold dipping down. So it might tell you that you have a chance to trade gold at that point. It can give you lots of things that you can see. You can see different views, different time frames. You can see different aspects and find the personality of the asset you're looking for. So again, if you think of your chart as a roadmap, so what we're doing right now is we've got this atlas out, and we know we need to go from London to, where are we going to? We're going London to Manchester. Okay, we know kind of the direction is. We know we got to go northeast. We look for it. We can real quickly eyeball the highways we need to get on. Well, that's what we're doing now. Okay. But now if we delineate it, we need to know what exit we're going to get off, what exit we're going to get on, where, how many kilometers or how many miles it is to the exit we want. We're starting to put pictures on there. Okay. If you get a little bit more on there, you might be able to know that, during the afternoon, it's very, very bad traffic out there, and you might be able to come up with an alternative route, or you come up to roadworks and perhaps an accident. Well, if you want to, zip off the highway to get around it, I can't tell you how many times I'd spend, hours and hours getting lost because I'd get off a roadway because of an accident and think, I can get around this, and there really isn't an exit that's that close, and I get lost trying to find the new entrance to the highway. If you get all this right, you'll stop getting lost. And that's why charts are critically important and the basics of charts. Because from here, we go on and we put on 3 bits of important information that can be incorporated in a trading strategy, but should be incorporated in your trading plan. Now, your trading plan should be the steps you follow at all times. And that is, you should always have a trend line drawn on your charts. And if you notice, we had drawn that short-term trend line. It's still on the chart in the red over here on the right. But now we can see that we're actually in an uptrend, and we can get a very good trend line here for an uptrend. And now if we shift this back to a shorter strategy, why did I lose my... Okay, we could see the long-term and the short-term trend lines on the charts. And there are many ways to do so. If you bring your lines of support and resistance for, but once we have our chart, we can start putting our trend lines, our short-term or long-term or medium, and then we can add volume to the charts, and then we can add support and resistance. And these are 3 basics. Whether you're going to trade from fundamental analysis or you're going to learn from trading systems, you're going to find signals. You can't do these without the basics. And really, if you're making a determination to trade, no matter how you're coming up with that, the trend line should support your determination, volume should support your determination, and support and resistance could help it. Now, you're asking me, why are charts important? Now, if you did all your proper market evaluations, say on a stock, period in, you've been watching, or BT Telecom's got this week? Yeah, BT has their earnings report today or tomorrow. Okay, if you think that's going to be positive, it's going to push the price up, or you think it's going to be negative, you want to find a bottom, where are you going to enter the market? Well, there's no other type of analysis that can tell you what price to enter the market. There's no other thing that you can use besides charts to tell you what price you should put your take profit point, or where you should expect, what price level you should expect to see resistance on price, except on charts. So all your analysis should tell you that, okay, BT Telecom survived all their scandals and all the problems they had in 2016. They're now reporting, and that year's behind them. They're now reporting because they're just reporting their full year. And now we're going to see a turnaround. And okay, so what price should you enter the market? How are you going to determine what price is a good price and where you should put your stop loss? Where do you want to protect yourself? You're going to get that only from your prices on your charts. So next week's class, we're going to talk about the trend is your friend and how to draw and how to set up short-term, long-term, and intermediate-term trends with different time frames, and how to start using these to make trading or to understand the markets and to incorporate them into your daily trading plan. The following week, we're going to look at support and resistance and adding those on. And really, there are lots of automated trading systems that use only trend lines, only support and resistance and volume to make trading decisions. Or we'll show you how, when we come to our class on patterns and chart patterns and trend patterns, without a chart, you won't be able to see a channel or a wedge or a triangle. You have to be able to recognize these on charts. And to do these, you have to be able to draw support lines, trend lines, and understand what's a breakout, what's a retracement, what's a continuation, what's a reversal. Again, you can't do those without charts. So on that note, I'm going to thank you all for joining us tonight. I hope you learned a little bit of something. And next week, we'll be looking at taking the same chart a little bit farther. Now, my recommendation to all of you is to take one chart, one asset. Okay. Pick whatever you want, not because you're going to trade it, not because you want to make money, not because you said, if you like Apple and you watch the news about Apple, take Apple. If you're going to Australia on vacation, take the Australian US dollar, the Australian GBP, the Australian, take whatever asset you want. Okay. and start looking at the chart each day. Join us along the way. Start looking at the candlestick. Start looking at the bar chart. Start drawing what you think should be trend lines on there. And then next week, we'll draw your trend lines on that particular asset. And we'll use that one class. Because once you get this down pat, you got it. Because trend lines, support and resistance and volume don't change. See, the rest of the indicators and oscillators that you're looking at change continuously, because you would change those based on market conditions. Like you might have one strategy that, which is made up of the indicators that works during a trending market. You have a different strategy and different indicators and oscillators you look at during volatile markets. Trend patterns happen. Now, how do you react when a trend pattern develops? When you see a head and shoulders, what other indicators and oscillators are you going to apply? Well, a lot of that depends on what is happening. Lots of people like to use RSI as stochastics. Well, they do well at the end of a trend, but they don't do well in sideways moving markets. So decide what, so all of that becomes more advanced into the strategy you're using. Okay, but the basics of your roadmap or your blueprint is, a blueprint has to start, no matter what you're building, has to start out with some things. The size of the piece of property, other reports, how deep you want to go. So if you're going to build a house, how many bathrooms, how many floors, and all of this stuff. An architect needs to have somewhere to start, but he also has to bring the electrical and the plumbing in correctly. He has to bring it in from the outside. He has to know where the power lines, all of this is the basics that he has to work with to then design the house you want. So on that note, I'm going to say goodnight to you all. Thank you very much for being part of the ETX family, and we'll see you next week. We'll see you on Sunday. This Sunday, I don't even know what the class is on Sunday, but you can find them all on the ETX website. This Sunday, we're teaching you how to read and use the economics calendar. So join us on Sunday afternoon, or it's late afternoon, and for that, or we'll see you next Wednesday for the Trend is Your Friend. Have a great evening, and thank you again for joining us. Good night now.